our twice a month a commercial meeting for the Southern California group. So excited to have today Jordan Brooks. He's with ALN, the apartment data. I guess it's you know, one of the biggest online sources in the nation. Jordan himself, you know, based, I think you're based in Texas, right, Jordan?
In Dallas.
Dallas, Texas. He's a market analyst, use statistics to, you know, show, improve, explain all the trends with the apartments. And I think I reached out to you about, I don't know, maybe almost a couple of months ago, and very courteous to kind of schedule a few, you know, months ahead of time to bring to that group. So you're a busy guy, Jordan.
Yeah, it's better for me to do it further out anyway. So yeah, it's worked out well, and I'm happy to be here with everybody. Oh, I think you're on mute now.
Sorry, there we go. There we go. Adding more people to the call as we go. Jordan, give us some background about yourself and ALN and what should we expect today from the presentation.
Sure. Yeah. So I'm a market analyst at ALN. Been in this position at ALN for 3 going on 4 years now. I started actually at the company about 7 years ago in the account management side. Went back to grad school for data science, and then transitioned into this new role after that. In terms of ALN, just as you said, we focus on the multifamily space specifically. So we research and collect data on multifamily properties around the country, and then we have web-based platforms that we offer to people in various segments of the real estate industry. And a lot of my job is kind of working with our data on behalf of clients, whether it's developing reports or writing for our blog or industry publications about what's going on in various markets and things like that. And then, yeah, in terms of the presentation, basically, I'm just going to go through kind of a high-level overview of the LA market from a multifamily perspective. I didn't want to get too crazy and throw too much at everybody in a short period of time, but I've got about 15, 20 slides, and happy to obviously take questions at the end, or if you want to hop in while I'm going, happy to do that as well.
Sounds like a solid plan. So go for it. I'm gonna make you a co-host so you can share a screen. And guys, feel free to type in your questions or unmute yourself if you have any questions to Jordan as we go. And unless you just want to go with the slides first, Jordan, and then question at the end, how would you like to?
If you wouldn't, maybe if you'll keep an eye on the chat while I'm going through, and then you can just interject if there's kind of a pertinent question, and then otherwise we'll have a little Q&A at the end where we can always go back and handle it that way.
Sounds good.
All right. Pull this up. You seeing my PowerPoint?
Yeah. Yes, we do.
Okay. Perfect. All right. So I'm going to skip through the about ALN information, other than to say we've been around for going on 30 years now. Methodology will be a little bit more pertinent to what I'm about to go through here. So as I said, we focus on multifamily only. The crux of our research is really multifamily properties that are above 50 units and conventional product, meaning not student, military, senior, et cetera. We do research on all of those segments and properties below 50 units. The reason we focus on that segment of the market is just operationally, it's much more difficult to get regular, consistent updates from a small, independently operated property than it is from a larger, professionally managed property. And then the other reason is we don't put those properties in our market statistics like rent and absorption and things like that, because a student or a senior property is operating on not just supply demand dynamics. They've got school terms for their occupancy, or they have additional care benefits that a senior housing project is offering that is built into rents. So it muddies the statistics a bit. So for the most part, we're going to be looking at conventional properties of at least 50 units, though there will be some exceptions to that as we go through here. And I point that out especially when I'm doing these type of things in a market like LA, where of course a good segment of the market is going to be those smaller properties. So just something to bear in mind as we go through here. So before, and let me see if I can get this kind of out of the way for us here. Oops. Before jumping into kind of the multifamily numbers, I wanted to give you a little bit of a high level view of just the market as a whole, in terms of population, income, things like that. So on the left-hand side, we're looking at the LA MSA. On the right-hand side, we're looking at the United States, and we're looking at total population here. These are the most recent years. 2020 is still preliminary estimate numbers. So, you can see that really about 2014, 2015 population growth started tailing off in the Los Angeles area. And then reversed and went into negative territory in the last couple of years. That's something that we would anticipate seeing continue when the 2020 numbers do come out. So kind of a downward trajectory there on population, though I should point out that if you look at the scale over here, given the total population, it's not like we're talking about some mass, 10% exodus or something of people. But having said that, obviously for real estate generally and for multifamily especially, you want to see strong population growth, which LA has not really seen for the last 5 years or so. On the household income front, a fairly good mix in terms of households falling into the various income categories. You'll notice a little bit more households on the LA side falling into the higher income spectrums, 100,000 and up, higher share there than in the nation as a whole. For real estate and particularly for multifamily real estate, we kind of like to see the 50,000 to 150,000 type range for kind of good, healthy demand across the price class spectrum for multifamily. It's at 100,000 or so in the LA region that you really start losing households to home ownership, especially 150 or above, but you do see kind of an uptick in the 100,000 range as well. A market more heavily skewed in that direction. And, for you guys doing a lot of single family, that's a benefit. For multifamily, like I said, we really kind of like the sweet spot of maybe 50 to 100,000. But overall, like I said, a fairly good mix there of households. Here we're looking at the MSA, and we're looking at the civilian labor force versus the employed labor force, and then the unemployment rate. So I know there's kind of a lot going on this slide. Let me see if I can get that. There we go. So the top of this gold shaded region is your civilian labor force. The top of the blue shaded region is the employed labor force. So the difference would be people, like the width of this gold band is people in the labor force but not employed. And then on the right-hand axis here, we're looking at the unemployment rate as a percentage. So obviously the huge jump in the March-April timeframe of last year in unemployment and the significant downshift there in the labor force generally. Unlike some other markets around the country, we've not really seen the same sort of acute downward move in that unemployment rate that we have seen in other areas. The LA MSA is still about twice the national unemployment rate, about double that rate. So unemployment remains elevated. The other thing I wanted to point out on this slide was that this downturn in the unemployment rate, some of that, of course, will be jobs being regained. But if you notice, there's still a pretty significant shortfall here in the actual labor force itself in this region here. And so a significant portion of that downturn in the unemployment rate is actually due to just people leaving the labor force, not trying to find new jobs, as opposed to coming back into the labor force and finding a new job. So, despite the downturn here in the unemployment rate, there's still kind of a lot of progress to be made on that front, just in terms of employment generally. Okay, so we'll get into some of the kind of multifamily performance metrics, but a couple slides before that, I just wanted to give you kind of a general breakdown of what the market looks like from a multifamily perspective. So here we're comparing the Los Angeles, Orange County market to the state of California. Region 10 refers to the National Apartment Association regions, which for Region 10, it's California and Hawaii. And then nationwide as well. So just kind of to provide some context of larger geographic areas here. So you can see that the LA area more heavily skewed toward conventional multifamily properties than any of those other geographic units. Despite there being universities there, not a lot of student housing. And you can see really for senior student affordable and low income affordable, pretty much across the board, lower amounts of those property types than in the state, the region, or the country. As a share of the total multifamily properties. And just for clarification as well, so affordable properties refer to like rebate properties, HUD properties. Low income affordable would be income restricted, so the resident has to make below a certain percentage of the poverty level in an area to be eligible to rent there. So pretty heavily skewed toward conventional properties really is the takeaway there. And then the same thing here for the floor plan breakdown. So what I did is we're looking at efficiency units, 1 bedrooms, 2 bedrooms, 3s, and then 4 or more. And LA, as you would probably expect, pretty heavily skewed toward those efficiency units, and as well as the 1 bedrooms. So about half or more, a little bit more than half of the total market in terms of multifamily are efficiency or 1 bedroom units. Not as many 2s, not as many 3s, and then almost none above that, which those tend to be the older properties anyway. But so heavily skewed toward conventional and heavily skewed toward efficiency in 1 bedroom. Okay, so here we're looking basically at a supply-demand picture. So new supply versus net absorption, and by net absorption I just mean the net change in the number of rented units for a period of time. And you can see that here we're comparing nationwide on the left to the state of California and then the LA market there on the right. And California as a whole and LA more specifically pretty much followed the pattern of what we saw at the national level in 2020. And obviously the national numbers are really driven by 8 or 10 of the biggest markets, LA being one of those. So that is part of that as well. But what you'll notice is that unlike at the national level, new supply was slightly lower in 2020 for LA than in the previous couple of years. And despite that kind of slight downtick in new supply, there was still a larger gap where the demand just wasn't there in 2020. So you can see a slight downturn in new supply and a much larger downturn in demand. And as I say, at the national level, there was an increase in new supply and the downturn in demand. So not as bad maybe as we would say just at the highest level national numbers, but ideally the demand would have bounced back. What we saw in a lot of markets was a really tough second quarter. And then apartment demand really kind of resurged in the third quarter and the fourth quarter to the point where demand really was stronger in those months than it had been in those same months of previous years. In LA, we didn't see that late 2020 bounce, and so that's why you're seeing that annual shortfall there. So this is the same graph type as the labor force graph that we looked at. And so the top of this gold shaded region is average market rent per unit, which would be the average asking rent. And then the top of the blue shaded region is the average of effective rent or collected rent. So basically the width of that gold band is your lease concession, the discount for new leases. And then on that right-hand axis, we've got the average occupancy. So a couple of things I wanted to point out here. The first of which is that you can see concessions were already kind of creeping back into the market in 2019. You can see this gold band getting thicker about here. And then going into late 2019, which, for multifamily and real estate generally, it's highly seasonal, right? So for multifamily, we generally see a strong second and third quarters with softer first and fourth. And so one of the points that I wanted to make, and I say this for pretty much every presentation, it's really, we don't want to fall into the trap of attributing everything to COVID, right? And so Some of these trends were there before COVID, whether we're talking about the reemergence of lease concessions, whether we're talking about an already emerging downward trend in average occupancy. So, these are things that we can't attribute 100% to the pandemic. Another thing you'll notice is that average occupancy really went on a negative trajectory throughout 2020. And as you'll remember from that new supply and net absorption slide, it's not like we saw a huge uptick in new supply that might explain that downturn in average occupancy. It was about on pace with the new supply we've seen in recent years. So occupancy struggled throughout 2020, and then you'll notice too that rents were still climbing through the first quarter of 2020. Both the asking rent and the collected rent were still climbing through the first quarter of last year, even while occupancies had already started declining. And then really we saw rents peak in March or April, and they're still not back to the level they were almost a year ago. And then you'll notice much wider band here. Concessions really made a strong comeback into the market. And also, I will point out, not only is there a little bit of a bounce here in average occupancy in the first 2 months of 2021, which obviously is a positive sign, but also, the market remains over 91%. That's about the national average. So, as I said, with the population loss, it's not like, occupancies went from average to terrible. It's just that, there has been a pretty pronounced downward trend, really for 24 or more months at this point. And then one other kind of perspective I wanted to show you is just what's going on with the existing market versus what's happening with new properties coming online. So stabilized properties, meaning these properties were, they existed, they were leasing prior to the start of 2020. And in fact, had already stabilized prior to 2020, meaning, they'd been leasing for at least a year, and they had at least 85% occupancy. Lease-up properties are newer properties that are coming online. They're starting to fill those units for the first time coming out of new construction. And so I took the LA market compared to the nation as a whole for each of these. And the first thing that you'll notice, obviously, is just the elevated rents in the LA market compared to the country. It's something like $600 or $700 a month more expensive in LA on average compared to the US as a whole. You'll also notice that for LA and the country as a whole, the stabilized properties didn't do as badly in terms of annual change. So the nationwide stabilized here, close enough to zero. They basically held their ground on rents in 2020. In LA, they were negative by about 2%, but you can see not nearly as negative as about the 10% loss in the lease-up properties. Generally, when we see rent softening in lease-up properties, it's because the concessions have gotten really out of control. And maybe, in order to lease these units, these properties are offering 2 months free on a 12-month lease or something like that. As we'll see on this slide, that wasn't so much the story with these lease-up properties in LA last year. As you can see, when we're looking at the percent change for the availability of lease concessions, there was a 8-9% increase annually. Not a huge jump. Certainly not enough to account for a 10% rent loss at the average. And actually, what it was that asking rents went down by about 9%. So we saw the rent shift not so much on the discounts, but on how aggressive operators were being with rents. And to explain this a little bit, on the left-hand side here, we're looking at the percentage of properties that are offering a discount. And then on the right-hand side, we're looking at the annual change for that value. So, it's very typical. We tend to see lease-up properties with much higher rates of discounts than we would see with existing properties. And that certainly held true last year. And you can see really that whether it was the nationwide or the LA lease-ups, it's not really that they pulled more heavily on the lever for concession availability. It was A, being less aggressive with asking rents, and then B, the average value of the concession would go up. And one other thing I wanted to point out too is for the LA area for stabilized properties, that's a really high, you can see, more than 70% increase last year and the availability of discounts. But the market was coming from about the national average of somewhere around 13 or 14%. So, again, it wasn't as though the LA area was coming from already an area of weakness and then concessions shot up again. It was more like the LA area had about an average level of lease concessions compared to the country. And then in 2020, the market shifted toward concessions more than the country as a whole. So a little good, a little bad there. Okay, and then, the perspective from which we really saw a divergence in performance in a lot of markets around the country was, of course, by price class. So ALN assigns every conventional multifamily property to a price class A through D, and we base that not on the location or the year built or certain amenities. We simply assign them based on their average effective rent per square foot percentile in their market. And so what that allows us to do is compare a Class A property in LA with a Class A property in Mobile, Alabama, because they operate in the same competitive space within their markets. And so here we're looking at average occupancy for each of the 4 price classes compared to what we saw at the national level. One thing you'll notice is that occupancies in the top 2 price tiers, Class A and B, are lower in LA than they are nationally, with the bigger difference being in the Class A's. You can see the Class A's, hovering there around 77 or so, 76% average occupancy. At the national level, close to 84%. And kind of the main theme, and it especially kind of reared its head in the price class area. The LA market, for the most part, kind of mirrored what we saw at the national level. It was just more pronounced. So, you can see Class A occupancy struggled the most at the national level, followed by B, and then C and D did comparably better. Same thing happened in LA. It's just that the losses were more pronounced. So instead of a 3.5% Class A loss, there was a 5% Class A loss, so on and so forth across these price classes. You can see that Class C and D in LA comfortably above 90%, lost less than 1% in average occupancy through 2020. And then also something that's important to keep in mind when we're talking about multifamily and occupancies, and especially in 2020, whether it was the moratoriums on evictions or the ubiquitous nature of payment plans and discounts and things like that. Typically, we would assume that an occupied unit is generating full rent for a property. That's obviously not something that we can assume for the 2020 numbers. And so it's just, kind of as a caveat to these numbers, particularly in the Class C and D, if you're a Class C operator and you say, okay, well, we kind of weathered the storm in 2020, our occupancy is still 94%. There's no guarantee at all that you're seeing 100% rent on that 94% occupied units. So something to keep in mind, and it's hard to measure. The National Multi-Housing Council kept monthly or weekly, actually, rent trackers, but their numbers did not distinguish between partial rent payments and full rent payments. They just announced X% of renters have paid a full or partial rent payment by Y date. And so there's not a lot of kind of high quality data at this point on exactly what percentage of occupied units paid full rent last year. So just something to keep in mind. And here we're looking at the same thing, but we're looking at average effective rent. And you can see, again, the first thing is just the rent differences between LA and the nation. And then the second thing also is, again, it's just more pronounced national trend is kind of what we saw. So Class A lost 4% or thereabouts in average effective rent. At the national level, it was a little less than 2%. Class B's lost almost 3%, whereas it was less than 1% at the national level. So the only real difference, as you can see there, is that in LA, Class C's were not in negative territory. Class D's just barely kind of held their ground on rents, whereas at the national level, it really was those two that managed to add anything at all. So, and again, I would say generally speaking, we saw a lot of markets defend occupancies at the expense of rent growth versus the other way around, which is what you would expect. But it's good to have numbers to kind of back that up. So this is kind of a busy slide, and I'll I can make these available via email as well for later viewing. But basically, what I did here is I just put the LA market in a table with the other larger markets in California, and just kind of listed a sort of 3-year change for various metrics that we watch for multifamily. New supply here, demand here, what the impact on occupancy and rent was of that dynamic, the availability of discounts, the average discount, and that percentage value is the percent off of an annual lease. So, for example, about 8% off of a 12-month lease is the average discount for LA multifamily. Average net rent per unit, and then that change. And you'll notice LA and the Bay Area did not perform on a net rent basis, and that's the metric that allows us to bring in occupancy and rent. And so the LA area, the Bay Area kind of lagged San Diego and Sacramento sort of in that totality kind of metric. And a lot of that has to do with the fact that most of the new supply has been focused in those two markets. You can see, almost 35,000 new units in LA, over 20,000 new units in San Francisco versus, less than 12 or about 12,000 combined for Sacramento and San Diego. So some of that just has to do with new units. And of course, we all know, whether you're on the single or the multifamily side, there's a huge housing shortage, not just in California, but in the country. The issue is, when you have new units coming online that are new, expensive Class A units, they're not actually servicing the demand of the housing. And so, at a glance, you might say, okay, well, this is a huge market. We've got a lot of new supply coming in. We know there's a housing demand. This is going to be great. But again, there's a mismatch between the supply and the demand, and that's how you get a situation where you've got 35,000 new units, but significantly less than that were actually absorbed units. Or in the Bay Area, 23,000 new units, but less than 9,000 over a 3-year period were added to the list of rented units. So, LA dodged the bullet a little bit compared to the Bay Area. You can see at least they've had some rent growth in that 3-year period on a net basis, whereas the Bay Area, it's actually gone the other way, but certainly lagging San Diego and Sacramento. So here, basically, we've got 32 submarkets in the greater LA area. And so I dumped them into some histograms here, and basically it's just showing how many of the submarkets fall into each of these baskets. And this is annual change for occupancy on the left and collected rent on the right. And so 2 real things to point out here. The first is that for both, you'll notice that the category with the most submarkets is the basket that's kind of straddling the 0%. Whether that's on the rent side or the occupancy side. So kind of stasis, really. But you'll also notice that there's a little bit of a negative skew here on the occupancy side, where more submarkets than any other category fall into this one that straddles 0%. But then the next 3 highest are all on the negative end of the scale. Whereas with average effective rent, it's pretty much a normal distribution. You've got you've got your peak here, and pretty much equal number of submarkets on either side of that peak. So again, when at the market level, we saw really occupancy be less soft than rents. At the submarket level, you're seeing that there actually was a little bit of a difference, right? So more submarkets that struggled on the rent front than on the occupancy front than on the rent front. So it's one of the reasons we like to look below just the market level numbers. And of course, I didn't want to give you just 2020 information. So here we're looking at January and February for 2019, 2020, and 2021. So just kind of giving you an idea of kind of what's typical for these 2 months in recent years, and then what have we seen this year. And so the first thing you'll notice here on the left-hand side with average occupancy is that average occupancy as of the end of February has been lower now for 3 straight years. You'll also notice, though, the good news is that unlike 2019 and 2020, where rent growth was basically flat, occupancy growth was basically flat in the first 2 months of the year. Here, there at least this year has been a little bit of a bounce back. And we saw that a few slides ago on the graph too, where the occupancy line bounced back up in the first 2 months of 2021. So that is a bit of good news. Once again, you can see that kind of follows the national trend, where there was a little bit of a bounce compared to previous years in these 2 months. And once again, it was just a little bit more pronounced in the LA market. So as I said, that was kind of a thing that held true throughout, was the LA market sort of looked like the national numbers, just a little bit more extreme. And then on the rent front, that pretty much held up as well. So if we look at nationwide rent change, a little bit of an underperformance so far this year compared to the 2 most recent years. And in LA, there's been an underperformance this year, just more so. And so again, occupancy is bouncing back up a little bit, but we've not seen sort of a retrenchment of any type of rent growth. And then just kind of looking ahead, some new construction information, and then just kind of a couple of things that we're watching for the market. So the first thing you'll probably notice is just the scale, the number of units in this pipeline, more than 100,000 units in the construction pipeline for the LA market. What's good about it is more than half of that pipeline has yet to break ground. You'll see here about 80,000 units in a pre-construction phase. So the reason I say that's a benefit is because that gives the area more flexibility. There's some more play in the joints depending on the situation on the ground. So, if we all find some wood and knock on it, short of another unexpected calamity this year, 2020 should provide sort of the trough of what we would expect to see, certainly from a multifamily perspective. And 2021 should be a little bit of a bounce back. So if for whatever reason that does not play out in the LA market, more than half of the pipeline having yet to break ground means that these are projects that can be put on hold, they can be delayed, they can be canceled. And so that just gives some flexibility, as opposed to being a market where 75% of the units are already being built, which means no matter what happens, those units are coming. And then on the right-hand side, we're looking at the total pipeline units as the blue bar, and only units that are currently being built but are not yet leasing or pre-leasing as sort of the gold bar. And so in other words, this bar represents the total pipeline, and this represents the units we know are coming basically no matter what. And so again, there's really not a submarket. I basically chose these top 5 submarkets based on total pipeline units, but these submarkets where the bulk of the new construction is going to be happening, and none of them are a majority of those units already being built. And so again, given that the new construction here isn't especially geared toward the actual housing demand, it's a net positive to see that greater downtown doesn't have 80% of its units on the way already being built. Like I said, that will provide a little bit of a cushion, some play in the joints for the market as a whole. And then just to wrap this up, some things to watch moving forward for the market. Status of the new construction pipeline. Basically, I just covered that one. The fact that a good share has yet to break ground is a positive. Negative population growth trend, as I said in the beginning, obviously for real estate, we want to see strong population growth. We don't want to see population losses. I suspect that the 2020 population numbers will look worse for LA than the 2019 or 18 numbers. But as I said, just as we have to be careful about not attributing too much to COVID, we also have to be careful not to just assume that every resident preference shift wrought by COVID is going to magically become a long-term fundamental trend, right? There is going to be some sort of snapback to normal. There will also be some more long-term change. And at this point, honestly, it's too soon to really say what that ratio might look like. But certainly the population trend is something to keep an eye on. Employer industry diversity, one of the things that we pay very close attention to is how diverse is the industry set that is making up the employment base of an area. So, it could be a large market that's really heavily skewed toward just one industry. It's more common to see smaller markets that are more reliant on one or two. LA, generally speaking, doesn't really have an issue with an over-reliance on one or even two sectors, which is a positive. The Bay Area, I think, got hit pretty hard because of a lack of business travel last year. LA obviously gets business travel, also gets tourism travel, things like that. The movie industry and things like that had a rough year. But overall, there's enough of a diversity in that employer base where it's not something that looking forward we're saying, oh yeah, they're relying on one or two sectors and those sectors are looking really weak and this is going to be a problem. So that's a positive for the market for sure. And then, we can't really talk about anything certainly in the 2021, 2022 timeframe without addressing, COVID and still some of the uncertainty that brings. So, as I said, short of some new calamity this year that is unforeseen, 2020 should kind of be the trough. That assumes that the COVID-19 vaccine rollout is going to continue apace and continue successfully, and that economic reopenings, particularly in areas like LA, where it's been slower to reopen, will continue at a pretty uninterrupted pace. So, if in 2021 we get to a point where something resembling normalcy is what we're seeing, especially from an economic standpoint, just in terms of economic activity, then, as I said, 2020 should not be the new baseline. It should be the point from which we kind of bounce back in a positive direction. So with that, what questions do you have?
Jordan, good job. That was good info. By the way, a lot of new data as well, a bit different than other presentation we've seen in the past. So it's a really good angle. Thank you for that.
Sure.
Couple of questions, and then guys, feel free to unmute yourself or type in your questions. But first one from Albert, I guess you're referring to one of the mid slides, is the average net rent per unit is based on one bedroom?
No. So what that means is, so when we say average net rent per unit, that's the net rent that's being earned per unit on a property based on the rent of that floor plan type and the occupancy of that floor plan type. So it will be across the unit mix. It just means at a single unit level, what is the average rent that a property is generating?
Got it. Thank you. I don't know if this question is really for you as an analyst or ALN, because it's more of a data source company, but are you guys involved somehow in any shape and form with the Tenant Relief Acts or the politics, or you have nothing to do with it?
No. I mean, we provide data to government agencies at the local, state, and national level. We work with HUD and things like that. So we're a data source for government agencies and advocacy groups and things like that. But we're not really active in the political sphere as it relates to real estate.
Understood. One more question is, where do you see the trend? I know that there's a lot of discussion, and maybe the guys over here, the guys and girls over here, will share in a bit as well from their experience. But a lot of principals from LA, besides actual people that moving from LA to the other big states like Dallas, Texas, right, or Florida, Arizona, etc. Where do you see any kind of migration of principals from LA to different states, different areas?
Yeah, I mean, I think honestly, that's one of the most interesting and important, factors in real estate generally right now. And kind of like what I said about, it's a little bit too soon to know, what share of the workers that went remote over the last year are going to remain remote, and what share are going to go back to the office, what share of people that maybe left the city centers for suburban submarkets or secondary cities are going to come back versus stay where they moved. All of these are going to have massive implications for real estate across the country. I think, yeah, we've seen, Texas, and again, some of this precedes COVID, right? I mean, Texas has been a growing real estate market for a long time now. So has Florida. Denver's been exploding for a while. Boise's been exploding. Nashville, parts of Arizona. So I think some of that was exacerbated by the pandemic. This is actually, I'm doing a panel discussion at the National Apartment Association conference this year in August, and this is the topic that we're going to be talking about. And so, yeah, part of it is, it's so new. There's no real data yet. We can try to aggregate, data from the moving services or things like that. But in terms of, the government putting out their standardized year-over-year migration shift data, we don't have it yet for 2020. And so I think a lot of this, honestly, is still kind of conjecture. Like I said, there definitely will be a permanent effect, and there will be people that left LA and moved to Boise that are going to stay in Boise. There will, though, be a shift back, and I think it remains to be seen. I mean, a part of it is just as the vaccine rolls out and things start to reopen, is that kind of it, or are we going to see some massive reinfection of some new variant, and various states want to start locking down again? And that's part of this too, is just people's decisions about where they move are going to be based on, was this a temporary disruption, or is this something that has a relatively high probability of being a cyclical thing now? And so, yeah, I would say this is a long-winded answer to your question, but I would say, generally speaking, growth markets that have been growth markets for 3 to 5 years now, whether that's areas across Texas, across Florida, Nashville, Boise, Denver, those areas are still going to be growth markets. I do think, though, that there's kind of a knee-jerk tendency to just assume that the sort of more traditional, expensive, dense coastal markets are, just going to be dead or something, which I don't think is the case.
Good insight, Jordan. You're a pro, and send me the link to that national convention. I would love to promote it as well, and then attend virtually, I guess, whenever it's going to take place. Well said. So here's another question in that kind of the same line. And you did mention that you don't have all the data, so I'm not sure if ALN has all the stats for 2020. But from what you saw, what do you have? Is there any dominant or a couple of dominant markets nationwide that experienced the growth as opposite to LA market, right, in the apartments in COVID year, in pandemic year 2020?
Yeah, I mean, off the top of my head, like I don't want to list a wrong market for you, but I can say one of the most pronounced things we saw in the data was, so we rank markets, we assign every market to one of 4 tiers in terms of size. And we actually do it not by population, but by size of multifamily there. So how many units in the market. And what we saw was, for the most part, the struggles last year were all in the largest markets. Our tier 1 markets are the 33 largest markets for multifamily presence. And, those are your LA, San Francisco, Boston, New York, Dallas, Houston, Atlanta, the big markets. That's where the pain point was. For all the rest, for 2, 3, 4, secondary cities, tertiary cities, a lot of them outperformed 2019 and 2018, whether you're looking at rent growth, occupancy, demand. And so when I quote the national numbers, and I think I mentioned it earlier, the national numbers obviously are driven by a small group of very large markets. That's just how the math works, right? And so if you take out the largest markets, and really you can further segment it and really say, take out New York, take out the California Bay Area, take out Boston, take out Chicago. LA was kind of straddling that line, but LA wasn't too bad. Take out really the 3 or 4, 5 worst markets, and things looked very different, honestly. And so I would say that in more, I don't know if I can say in more markets than not, but certainly in a significant portion of markets, and we're fully nationwide. We base our markets on the Census Bureau's MSAs. So, we've got over 100 markets around the country, and a significant portion of them did better in 2020 than they did in 2019.
Thank you. Guys, what are the questions you have for Jordan while we have him live as a guest speaker over here? Good stuff, Jordan. Other question, guys, feel free to unmute yourself or type in your questions, if anything. Monty?
Yeah, so we had a lot of data here. Thanks a lot for that. What's the good news in the LA market? Any good news in the data that you have? You mentioned about slower new construction and things like that, but can you summarize what's the good news from all this for LA market?
Sure. Yeah, I think the status of the new construction pipeline is a positive. I think that all things considered, LA weathered the storm reasonably well last year. All you have to do is look at the San Francisco Bay Area a little further north to see a market that really kind of took it on the chin last year. So in that regard, it certainly was not the bloodbath that it could have been, or that it was in some areas. Also, like I said, there's just the sort of the structural strengths of, there's always going to be housing demand in LA. It's a huge economy. Lots of different sectors are active there. The profile of household income looks pretty good. So yeah, it's certainly not an entirely bleak picture by any stretch of the imagination. And as I said too, I think last year should kind of be the worst of it. This year it may not be a banner year, but it almost certainly won't be as bad as it was last year. And so all of those are positives. I will say, I hate to throw a negative in your positive question, but one other thing that I didn't mention that I should when it comes to multifamily is the issue of rent control. On the multifamily side, there are going to be some issues in the next couple of years because rents went backwards last year. And so the rent cap is going to be based on the lower value. And so it will take these operators a couple of years probably to get back even to where they were coming into 2020. So it's just something else to consider as well. But no, it's certainly, it's not entirely a doom and gloom story by any stretch of the imagination for LA.
Yeah, there seems to be a big divergence between single family and multifamily units, right? The single family is almost no inventory, and multifamily, you said there's a significant amount available, right?
There's definitely more inventory on the multifamily side. And like I said, that some of that has to do, and it's a factor on the single family side too, but it's to what extent does the new supply match the demand, right? And for multifamily in particular, and just about any market in the country at this point, it's really hard to develop a new multifamily property that's going to come into the market and be, a class B or a class C rent, affordable housing without meaning, HUD or anything like that, but just, colloquially affordable, right? And so in an area like LA with, super expensive land and it takes a long time to build things there and things like that, it's only more so. And so, yeah, there's certainly no multifamily shortage at a granular level. And in fact, on the slide we're looking at, right, it's, more than 10,000 units more were added than were absorbed in a 3-year period. So it's really, and if we go back to the price class occupancy, there's not a lot of availability here in the class C and D. They're both around 95% or higher. So there's not a ton of stock available. Where the stock is available is up here in class A, where it's, 2,000 plus a month. So that's more the issue. It's not as much a supply issue, it's just where does the demand and supply intersect.
Verified market. Yeah. Thanks.
Thank you, Monty. Other questions, guys? Is this something you can share with me, Jordan, via email?
Sure.
That presentation I can then send to the group afterwards?
Yeah, you know what? So I'll send you this, and then I'm also going to send you. We just released a new report where we basically combine multifamily data with a lot of like BLS and census data that I think might actually be relevant for you guys. Types of transit to work, transit time, share of household, renter versus own based on income, things like that. It's like 17 or 18 pages of data, all in graph form. So I'll send you that as well. We release it quarterly, and so this will be the most recent one will be for Q4 2020, but you might find that useful as well.
That's great.
One question.
Sam, go ahead.
Jordan, I have a question. Does QE have any play in this quantitative easing? You know, the inflation.
Mm-hmm. Oh yeah,
obviously
of
cost
course.
of living is going. Okay, so do you think that the exodus that we're talking about, does that have anything to do with that, with the major inflation in bigger cities?
I mean, that probably has more to do with cost of living generally. Inflation is of course a part of that, but yeah, I mean, honestly, last year was, books will for sure be written about this, but it's what you had was, in a lot of the cities that had it hardest, not only are they very expensive, but they're very dense, right? So people were looking for lower cost and lower density in the middle of a pandemic. And so whether that meant you're moving from your downtown efficiency to a suburban 2-bedroom apartment where you can have some space to work, or your kids are e-learning, or whether that meant moving from Boston to a secondary city in Massachusetts or something. So I think that there was already a trend in place, and that's why I said going back even a few years where and for LA we're talking really about Denver and Boise, maybe most specifically, right, and to a lesser extent maybe Seattle or Portland, but really it's people going from the expensive dense West Coast markets to relatively expensive but not as expensive Mountain West markets. And then that kind of played out regionally across the country too. People in Atlanta going to Savannah and Augusta and the smaller markets. And like I said, the secondary and the tertiary markets, many of them had banner years last year. So yeah, I think whether you're talking about a flight to affordability, moving from a class A to a class C, or from an LA to Fresno, we saw that basically across the board. And I think that may well continue. And then of course you also have to think about all the companies that are moving, right? Companies moving, taking workforces, leaving a workforce and hiring a new workforce in another place. I think we're kind of at an intersection of a lot of major shifts in population change generally. And that's going to be really affecting our industry.
Yeah.
And that's because of the high state tax. One last question. Someone mentioned about the good news. I want to hear bad news, because as a real estate agent, sometimes you want to share the bad news. It helps the seller make their decision. I'm not trying to be a pessimist, but do you have any bad news for us in Los Angeles?
Well, so the population trend isn't encouraging. So that would be one. And then, from a multifamily perspective, again, it's the misalignment of supply and demand. So you're getting really, really expensive units coming in, and the demand is at a price point $1,000 a month lower than. I think, and that's why I also said too, if, and like I said, find some wood and knock on it. But if God forbid we find that we're in a cycle of like there's a global pandemic every 20 months now, and countries lock down or certain states lock down and others don't. Like, people will be accounting for that in their decision making, whether it's, okay, I'm going to leave this state and go to this state or whatever it may be. And so that's, that's a hypothetical that we can't really worry about, but it's just, it's something to keep in mind, because I personally, my own opinion, I think that a lot of these population shifts that we saw specifically because of COVID are maybe a little bit overblown when people just assume that they're going to be long-term. Like I said, there were some shifts preceding COVID that are completely legitimate, and I definitely think will continue. But we shouldn't just pretend that, oh yeah, people left New York and LA and they're never coming back. But yeah, I mean, the population trend is not encouraging. And then just, the general cost, as you said, the taxation, things like that, more and more companies leaving. Over time, that is going to have an effect. People want to move where the companies are, where the jobs are, where the taxes are low. And so, that's got to be considered.
Thank you so much.
Sure.
Thanks, Sam.
Well, thanks for the invitation. I really appreciate it.
Pleasure, Jordan. Good presentation, good content. Thank you for your time as well. Send us the other information. We'd love to see you on the virtual stage with the National Association over there. But Jordan, stay safe, be well. Thank you for doing a great job, and thanks again for your time.
All right, you as well. Thanks.
Thanks, everybody. Good to see you all. Talk to you soon. Stay healthy and busy, and using the platforms, by the way, that we have.